Hi there, I welcome you again to the fourth chapter of this course on candlesticks for beginners. In the previous two chapters, we were talking about single candlestick pattern and we learned not one, not two, we learned about 6 single candlestick patterns. From this chapter onwards, we'll be talking more about the multi candlestick patterns and how can they be used by traders to make informed trade decisions and make a decent return on the money which they invest in the market. So let us begin our discussion on understanding the multi-candlestick pattern. So what exactly are multi-candlestick pattern? I think you must have guessed it by now. These are patterns which are formed by a series of prior candles. Basically, the historical candles have a significance on the trend which is expected in the market in days to come. While analyzing these multi-candlestick patterns, the traders has to look previous 2, 3, 4 candles to be able to understand what could be a likely move which is expected in the market in the next candles. So unlike in the single candlestick pattern where the previous candles didn't hold much of a significance, in case of multi-candlestick patterns, the previous candles have a lot of significance for the outcome of the market. Now in this chapter and the chapter to follow, we're talking about the following multi-candlestick pattern. We're talking about the engulfing pattern, piercing pattern, the dark cloud cover, the harami pattern. It's not a Hindi word, it's a Japanese word. The candle gaps, the morning star, and the 3 white soldiers. So these are 7 multi-candlestick pattern which we'll be covering in these 2 chapters. So let us talk about the first multi-candlestick pattern, and I'm talking about the engulfing pattern. Now this is actually a very easy pattern and it is also the most effective pattern in the market. So if you look at the picture on the right hand side of the screen, I have drawn 2 patterns. The first is the bullish engulfing and the next is a bearish engulfing. So the bullish engulfing gives you buy trades and the bearish engulfing is expected to give you weaker or a bearish trades in the market. This is the most basic amongst the 2 candlestick pattern, and the first candle here is relatively small as compared to the next candle. So in case of engulfing candle, the second candle is completely engulfing the first candle. Now if this pattern is happening at the bottom of the bearish trend, we can call it as a bullish engulfing, and if this pattern happens at the top of a bullish momentum, we can say it's a bearish engulfing candle which has happened in the market. So what is a bullish engulfing candle? So it basically gives you buy or long trade in the market. So basically the second candle here is green and the first candle here is red. The prior trend, if it's bearish by nature, this pattern has a very high success rate. Basically we are seeing continuous downslope in the market, but once the bullish engulfing pattern happens, you can expect a trend reversal in the market. The prior candle should be red, as I've already mentioned. The engulfing candle should be bigger than the prior candle. This is the most important and the only criteria for the formation of engulfing pattern. For a bullish engulfing pattern, the prior candle should be red and the next candle should be green, and it should completely cover the body of the engulfed candle. Now this is a chart of Infosys and you can see the bullish engulfing pattern here. Now if you carefully look on the chart, the 2 candles which are marked in the oval, the prior candle is red and the next candle is green, and which is completely engulfing the body of the prior candle. So once this pattern happened, you can see the market, although in the next few days had a red candle, but those were small red candles and they couldn't even come halfway to the green candle which was engulfing the red candle. And once we got confirmation with few bullish candle, you can see the momentum which happened in the market. Over a series of next couple of months, the market gave you a return of nearly 20% on the trades. So this is how strong this pattern is. If you spot it at the right time and you get a right entry, the risk to reward ratio is also very good for the trades. Again, what is bearish engulfing? It is exactly opposite of the bullish engulfing pattern. This pattern actually gives you bearish trades or short trades in the market. The prior pattern, if it's bullish, then the confirmation comes once the formation happens and you get very good risk to reward trades in the market. Now, how does this candle formation happens? The prior pattern, as I told you, is bullish. But on the day of the formation of this pattern, we see continuous selling from the bears in the market. All of the bulls try to push the market up, but they can't sustain the buying pressure. Eventually, the market gives way and we see an engulfing candle, which is bearish engulfing in this case, happening on the charts. The engulfing candle, which is red here, should be bigger to the prior candle, and it should be covering the whole body of the green candle. Now this is a chart of Venki's chicken. If you see the bearish engulfing candle here, the prior trend before the formation of the engulfing is bullish, and once the bearish engulfing candle happens, you can see the kind of momentum which happened in the market. The market almost fell from nearly 3000 levels to the low. If you had caught it, almost gave you a low of nearly 1500 rupees. So it's a almost 50% return on the shorts which you take. If you come to the extreme right again here, if you look at the cursor which I pointed on the screen here, we see a bullish engulfing candle. The red candle, if it's completely engulfed by a green candle which is bullish engulfing, and look at the trade which came after that. It gave a nearly return of 30%. So on this one chart of Venki's, you got both bullish engulfing and bearish engulfing candle formation in the market. The next pattern I'll be talking about is called a piercing pattern. This is actually, you can say, a mini form of bullish engulfing candle. It is very similar in nature. The prior candle is red and the next candle is green, but there's a small difference. What is the difference? The size of the green candle. In case, if you remember, in the bullish engulfing, it should be completely engulfing the red candle, but in case of piercing pattern, the size of the candle of the green one should be 50% to 100% of the previous red candle. Now say if the size of the red candle is 100 units, then the size of the green candle should be anything between 50 units to 100 units. It shouldn't be more than 100 units, and it shouldn't even be less than 100 units. So that is how a piercing candle formation happens. And the next pattern which I'm talking about is called the dark cloud cover. This is actually almost a mirror image of the bearish engulfing candle. The only difference again is in the size of the candle. Now the prior pattern here again is bullish, and once the formation of this candle, that is a dark cloud cover candle, happens, you can expect bearish momentum in the market. Again, the size of the red candle here should be between 50% to 100% of the prior green candle, and that is the only differentiating factor here. Say if the size of the green candle is 150 units, then the size of the red candle should be anything between 75 units to 150 units for the completion of the pattern of the dark cloud cover. So that is it from me in this chapter, which we talk about the multi-candlestick pattern. In the next chapter, we'll talk about 4 more multi-candlestick pattern. Do stick around for that chapter, because that chapter marks the completion of this course also. So I hope you understood these 3 patterns here. If you haven't, please again go through this chapter, because these patterns are actually give you very good risk to reward trades, and these are more trend reversal pattern. I thank you for your patience here again. I can see you in the next chapter. Thank you so much.